What is the difference between intrinsic and extrinsic value in options? Imagine you're looking at an option and wondering what makes up its price. It's like trying to understand what part of a car's price is for the engine and what part is for the paint job. In options trading, the total price of an option is made up of two main parts: intrinsic value and extrinsic value. Knowing the difference between these two helps traders figure out what they are really paying for and what potential profit might be ahead. Intrinsic value is the real, immediate value of an option if you decided to exercise it right now. For a call option, which gives you the right to buy a stock at a certain price, the intrinsic value is the difference between the current stock price and the strike price, but only if the stock price is higher than the strike price. If the stock is trading at $50 and your strike price is $40, the intrinsic value is $10. If the stock is below the strike price, the intrinsic value is 0 because exercising the option wouldn't make sense now. For a put option, which gives you the right to sell at a set price, the intrinsic value is the difference between the strike price and the current stock price, but only if the stock price is lower than the strike price. If the stock is trading at $30 and your strike price is $40, the intrinsic value is $10. If the stock is above the strike price, the intrinsic value is 0. Essentially, intrinsic value shows what profit you'd get if you exercise the option immediately. Extrinsic value is the part of the option's price that goes beyond its intrinsic value. It's sometimes called the time value because it reflects the chance that the option could become more profitable before it expires. Factors like how much time is left until expiration, the level of implied volatility, interest rates, and expected dividends all influence extrinsic value. For example, if an option has a lot of time left before expiration, it usually has more extrinsic value because there's more opportunity for the stock to move. As the expiration date gets closer, extrinsic value tends to shrink, which is called time decay. Out-of-the-money options, where the intrinsic value is 0, are made up entirely of extrinsic value. This is because they have no immediate profit if exercised now, but they might gain value if the stock moves favorably. In simple terms, intrinsic value is the actual, real profit you could make right now if you exercise the option. Extrinsic value is what you're paying for the chance that the option might become more valuable in the future. When traders look at options, they want to understand how much of the price is real value and how much is potential. High extrinsic value can be attractive to sellers because it decreases over time, giving them a chance to profit from time decay. Buyers, on the other hand, might look for options with high extrinsic value if they expect big price swings or increased volatility before the option expires. Knowing the difference helps traders make smarter decisions and manage their risks better.